Okay, let's get straight into it. We're looking at a silver market where, yeah, the paper price might seem, somewhat stable, around $48 maybe, but underneath there's a storm building, faster than anyone expected. So the real questions are stark. Is the window for actually buying physical silver closing? And what on earth happens if institutional demand suddenly multiplies, say, 50-fold overnight? Especially into a market that feels like it's already running on fumes. Today, we're doing an urgent analysis based on recent insights from precious metals expert Andy Schectman. He's been sounding some serious alarms. Our mission here is to cut through the noise and understand the real risk. Because Schectman's saying the danger isn't just price swings anymore, it's about physical availability. Can you even get your hands on it?
That's exactly it. That's the core message we really need to absorb from what he's saying. But hang on, before we dive into the refinery log jams, those crazy short positions, and the whole institutional demand thread, just take a quick second, make sure you're subscribed wherever you're listening. We do these rapid briefings, pulling together the key data points, and you really don't want to miss the next one. It's about staying informed quickly. Okay, so Schectman, he doesn't mince words. He comes right out and says silver right now is just a fundamentally better investment opportunity than gold. Now, he's clear. Both metals are likely going up. But the potential in silver, he sees it as way, way higher.
That's a pretty bold call. I mean, gold's always seen as the ultimate safe haven, right? What's the logic there? Why silver first?
It all boils down to market distortion, specifically that gold to silver ratio. You look at geology, how they're actually mined. It comes out of the ground at roughly, 16 to 1. And historically, for centuries, really, that's what the price ratio hovered too. About 16 ounces of silver bought you 1 ounce of gold.
Right. And today we're looking at what, closer to 80-1 still?
Exactly. Around 80 to 1. That's like 5 times the historical or geological norm. It screams that silver is just radically undervalued compared to gold.
So that massive gap suggests silver has a lot more room to run, percentage-wise.
Precisely. Schectman points to that imbalance as the key reason for silver's explosive potential. He even mentions he's actively helping clients do gold to silver swaps right now.
Trading the relatively expensive gold for the relatively cheap silver.
Yeah, basically betting that the ratio has to revert closer to the historical mean.
Yep.
If it just closes half that gap, the gains compound massively. He does add a quick reminder, though, that kind of swap. It's a taxable event, so you need to be aware of that. But the underlying point is silver's trading at a tiny fraction of its sort of natural real-world value.
Okay, the potential based on the ratio is clear. But let's shift to the immediate warning signs he's flagging. He's saying this isn't theoretical anymore. The physical market is actually tightening to a breaking point right now. What's the hard evidence? What shows this isn't just normal market buzz?
There's quite a bit, actually. First, the bullion banks, the really big players. Reports indicate they've actually doubled their short positions on silver recently.
Doubled down. While physical is getting tight, that sounds counterintuitive.
It does. It's like they're betting the paper price will fall, even as the physical reality is screaming scarcity. They're fighting a tide they can't really control, it seems.
A dangerous game, pitting paper against physical reality.
Definitely. And the most concrete evidence, the refineries, the sources are clear. They're absolutely swamped, backed up. They're actually rationing their output.
Rationing, so they're deciding who gets metal.
Essentially, yeah. They're prioritizing the big orders, kilo bars, 10-ounce bars, because massive institutional and even government orders are flooding in. That leaves the smaller stuff, like the popular investor coins, really scarce.
But why did they get caught so flat-footed if they're the bottleneck?
Well, think about it. They scaled back production significantly during the summer, which is usually slow. Seemed logical at the time. But now, this wave of, frankly, panic buying globally has hit, and they just can't ramp up production fast enough to meet it.
And that bottleneck pressure translates directly to higher costs for individuals.
Immediately. Schectman uses the U.S. Silver Eagle as the prime example just a few weeks ago, maybe $4 or $5 premium over the spot price. Now, he's seeing $8, $8.50, even $9 over spot. Daily increases.
Wow, that jump in the premium, that's like the market telling you directly how incredibly tight supply is right at the retail level. It's pure scarcity pricing.
It's a perfect signal. And it's not just retail feeling it. He mentioned major U.S. dealers like SD Bullion and JM Bullion saw their entire stock of 1,000-ounce bars, the big institutional size, sell out practically overnight.
1,000-ounce bars gone overnight. That's serious volume disappearing.
Huge volume. And then, add this layer. The U.S. government officially reclassified silver as a critical mineral, essential for national security.
Okay, critical mineral. That changes things, doesn't it? That's basically the government saying, we need this, putting a guaranteed demand floor under the price. They'll buy what they need for defense, tech, industry, regardless of cost.
Absolutely. It guarantees a baseline level of demand that isn't price sensitive, further squeezing the already tight global supply.
So you've got strategic government demand hitting massive institutional interest, while big consumers like India and China are just importing record amounts.
It sounds like a perfect storm draining global stocks.
That's the picture Schectman paints. It's a confluence of factors all hitting at once. Okay, let's just pause for a second here because that is a lot of tightening pressure building up incredibly fast. If you're finding these specific details, these data points, valuable for understanding the situation, then please take this moment right now and make sure you're subscribed. We'll be right back to talk about Schectman's specific advice on how to buy now and the math behind that potentially game-changing demand shock.
All right, so given the scarcity, Schectman's advice on investment strategy right now is really pragmatic. It's simple. Focus ruthlessly on accumulating ounces. Maximize your weight. Forget about high-premium collectible stuff for now.
Right. Weight over collectability. So which forms of silver give you the most metal for your money right now, according to him?
He points to a few options that really stretch your purchasing power. One interesting one is junk silver.
Okay, remind us what that is exactly.
Sure, that's just pre-1965 U.S. dimes, quarters, half dollars that were made of 90% silver. He notes that often you actually get about 4% more actual silver per dollar spent with junk silver compared to even a standard 10-ounce bar. Besides junk silver, the larger formats like 10-ounce bars and kilo bars are also good for just getting sheer weight efficiently.
And those popular coins, like the silver eagles we talked about with the soaring premiums.
Yeah, his take is blunt. They're too damn expensive right now. If your goal is pure accumulation, the premiums are just too high.
So if someone still prefers sovereign coins for recognizability or whatever reason.
Look at the alternatives. He mentions Australian kangaroos, Canadian maple leafs, South African Krugerrands, or the British Britannias. The sources suggest these are often still trading maybe $3, even $4 cheaper per coin than the U.S. Eagles right now.
Right.
That adds up fast if you're buying quantity.
Makes sense. Focus on the lowest premium per ounce.
Exactly. Now, he does admit he personally loves some of the collectible stuff, like old Morgan silver dollars, calls them mystical and special, and even the Eagles have appeal. But for strategy now, they're secondary to just getting the most ounces you can.
Okay, practical advice. But what about people who find physical storage difficult or want more liquidity? There are digital options like Glint. Schectman seemed cautiously positive.
Yeah, consciously positive is a good way to put it. The big pro he sees is democratization. Platforms like Glint let you buy tiny amounts, dollar cost average, and with maybe just $5. That makes it a pretty good liquid alternative, instead of just letting cash sit in a checking account losing value.
But there's always a but with non-physical holdings, isn't there? The old rule about custody.
Absolutely. The golden rule still stands. If you don't hold the keys, you don't hold your coins. That's his core warning. With something like Glint, the metal is allocated. That means it physically exists in a vault somewhere, backing your digital claim. That's good.
But allocated isn't the same as segregated, right?
Yeah, correct. It's not segregated. Think of allocated like you own a share of a big pool of silver. Segregated means that specific numbered bar over there in that specific vault location is yours and yours alone, with your name on it. So for ultimate security, especially against system-wide risks, physical possession or fully segregated vaulting has to be the priority. Digital is more for, say, flexibility and short-term liquidity needs.
Got it. Okay, now here's where the analysis gets really interesting, but potentially alarming. The institutional threat to supply. We know supply is tight now for retail, but what happens when the big money, the institutions, finally decide they need a piece?
Yeah, this is where Schectman lays out a pretty stark warning, and it's based on simple math. Right now, globally, if you look at all financial assets, stocks, bonds, real estate, everything, precious metals make up less than half of 1%, 0.5%.
Less than 0.5%. That's tiny, considering all the talk about diversification.
It's incredibly low. That includes everyone, too, from small stackers up to huge pension funds and endowments.
So why would that percentage suddenly shift? Aren't fund managers mostly focused on traditional markets?
Well, the narrative is shifting, big time. Concerns about inflation, currency debasement, just general systemic risk. They're getting louder. And Schectman points out, You're starting to hear major players, guys at places like Goldman Sachs, Morgan Stanley, seriously talking about recommending 20%, maybe even 25% allocations to hard assets for their clients
Oh,
as a defensive measure.
20 to
It's
25%.
near zero now.
That's a monumental shift. What if the global average allocation just inches up, say, to a level other experts talk about, like 5%?
Right. Schectman uses that 5% figure, which Rick Rule often cites as a more historically normal or perhaps conservative allocation. If global allocation merely goes from 0.5% to 5%, the resulting demand for physical metal multiplies by 50-fold increase in demand.
50 times. Wait a minute. Given the current mining output and inventory levels, that sounds mathematically impossible to satisfy.
That's exactly his point. It is impossible. The sheer volume of money that would represent trying to chase a finite amount of physical silver,
Yeah.
the numbers just don't work. He puts it bluntly. Say it's all gone, folks. There would be nothing left tomorrow. It's not hyperbole. It's just the arithmetic of trillions potentially chasing millions of ounces.
So if institutions start acting on even a fraction of those recommendations, moving to just 1% or 2% allocation, the average person trying to buy could be completely locked out almost instantly.
That's the fear. And we're seeing the early signs already. He mentions reports of actual physical queues forming in places like the UK, Australia, people literally lining up to buy metal. Getting your hands on physical metal, he insists, is going to become much harder than people think, and likely very soon, driven by this looming institutional wave. The window really feels like it's closing.
Okay, so given this perfect storm, the tightening supply, the critical mineral status guaranteeing industrial demand, this massive institutional shadow demand, where does Schectman see the price going near term?
He's definitely bullish. He completely dismisses forecasts talking about silver maybe dropping back to $40 or something. He thinks that's highly unlikely now. Instead, he sees the next immediate target zone for silver hitting somewhere between $60 and $65 an ounce.
60 to 65, and that's based on.
Based on the relentless physical demand, the refinery crisis acting as a bottleneck, that government underpinning, and just the sheer historical context, it mirrors past metal cycles, but on a much bigger global scale this time.
So let's wrap this intense analysis up. The final provocative question Schectman essentially leaves us with is this. If silver really becomes a critical choke point in whatever comes next, needed for industry, needed for wealth protection, will you be someone who already secured yours? Or will you be one of the many potentially left waiting for a delivery confirmation that just never arrives because there's simply none left to deliver?
Yeah, that's the crux of it. The bottom line message from all this data is pretty straightforward. The biggest danger isn't really that the price might pull back temporarily. You can usually recover from a price dip. The real unrecoverable danger is missing out entirely because availability dries up. Like Schectman says, you can recover from a pullback. You can't recover when there's nothing left to buy. Availability is the key risk now.
That is the critical insight from Andy Schectman's latest analysis for today's market. If this conversation helped you connect the dots on what's unfolding, please make sure you're subscribed right now, wherever you get your audio. Join us next time for more essential analysis and insights.